Silver has been used as money and a store of value for thousands of years. But today, silver is also a critical industrial metal used in solar panels, electronics, electric vehicles, medical equipment, and many other products. That means silver is influenced by both investor demand and industrial demand. In this video, we'll explain what silver is, why investors buy it, the different ways you can invest, how interest rates affect silver investments, and the risks you should understand before investing. Silver is a precious metal that has been used for trade, jewelry, and storing wealth throughout history. Unlike gold, a large portion of silver demand comes from industry. Silver is used in technologies such as solar energy, electronics, medical equipment, batteries, and electric vehicles. Because silver has both industrial and investment demand, its price can sometimes behave differently from other precious metals. Investors buy silver for several reasons. Some see it as a store of value during uncertain economic periods. Others use silver to diversify their portfolio beyond shares, property, and cash. Some investors believe growing demand from industries such as solar energy and electric vehicles could increase demand for silver over time. Others simply view silver as a way to gain exposure to a different asset class. Like any investment, silver has potential rewards and risks. There isn't just one way to invest in silver. Different investors choose different methods depending on their goals, experience, and risk tolerance. Let's look at the 4 most common options. The most direct way to invest in silver is by buying physical bullion. This can include silver bars, silver coins, or silver rounds. You can purchase silver from local bullion dealers or online dealers and take ownership of the metal yourself. The advantage is simplicity. You own the silver directly and aren't relying on a company or financial institution. The disadvantages include storage, insurance, security, and dealer premiums above the market price of silver. Another option is a silver ETF. ETF stands for Exchange Traded Fund. These funds allow investors to gain exposure to silver prices without storing physical metal. You buy ETF units through a share trading platform, just like buying shares. ETFs can be a convenient way to invest in silver, although you don't physically hold the metal yourself. Instead of buying silver itself, some investors buy shares in silver mining companies. These businesses explore for, mine, and sell silver. Mining shares can be purchased through stock trading platforms. If silver prices rise, mining companies may become more profitable, which can cause their share prices to rise. However, mining companies also face business risks such as rising costs, equipment failures, political risks, and poor management decisions. Because of this, mining shares are often more volatile than silver itself. More experienced investors may use silver futures contracts. A futures contract allows investors to speculate on the future price of silver without owning the metal directly. These contracts are traded through specialist brokerage platforms. Because futures use leverage, investors can control a much larger position with a relatively small amount of money. This means gains can be amplified, but losses can be amplified too. For this reason, futures are generally considered one of the higher risk ways to invest in silver. I'll explain futures contracts in detail in another video. Interest rates can have a significant impact on silver investments, but they don't affect every silver investment in exactly the same way. Let's look at each one. Physical silver bullion. when interest rates are low. Silver does not pay income. When savings accounts, bonds, and term deposits pay very little interest, investors often become more willing to hold silver. Low interest rates can also stimulate economic growth, increasing industrial demand for silver. This combination can support higher silver prices. When interest rates rise, investors can earn more from income-producing investments such as savings accounts and bonds. Because silver produces no income, some investors may move money away from silver and into those alternatives. Higher interest rates can also slow economic growth, reducing industrial demand for silver. This can place pressure on silver prices. Silver ETFs generally follow the price of silver. If silver rises, ETFs typically rise. If silver falls, ETFs typically fall. Because ETFs track silver prices, they are usually affected by interest rates in a similar way to physical silver. The main difference is that ETFs offer easier access through a trading platform. Mining companies can benefit from lower interest rates in two ways. First, rising silver prices can increase profits. Second, mining companies often borrow money to fund new projects and expansion. Lower borrowing costs can improve profitability and support growth. As a result, mining shares can sometimes rise faster than silver itself. Higher interest rates can create additional challenges for mining companies. Borrowing becomes more expensive. New projects may become harder to finance. Investors may also move money away from higher risk mining stocks and into safer income producing investments. Because of these factors, mining shares often experience larger price swings than physical silver. Futures contracts are primarily driven by expectations about future silver prices. Interest rates still matter because they influence economic activity and investor sentiment. However, futures traders are often focused on shorter-term price movements. Because futures use leverage, even small changes in silver prices can create large gains or losses. Like any investment, silver comes with risks. Silver prices can be volatile. Industrial demand can rise and fall with economic conditions. Physical silver has storage and insurance costs. Mining companies face business and operational risks. And futures contracts can create significant gains or losses in a very short period of time. Understanding these risks is just as important as understanding the potential rewards. Imagine you invest $1,000 in silver. If silver rises by 20%, your investment grows to $1,200. If silver falls by 20%, your investment falls to $800. Now imagine a silver mining company whose profits rise significantly because silver prices increase. That mining share may rise more than silver itself. But if silver prices fall, mining shares can often fall even faster. This is why different silver investments can have very different risk and reward profiles. Key takeaways. Silver can be invested in through physical bullion purchased from local bullion dealers, silver ETFs purchased through trading platforms, silver mining shares purchased through stockbrokers, silver futures contracts traded through specialist futures brokers. Each method has different risks, costs, and levels of complexity. There is no single best option. The right choice depends on your goals, experience, and risk tolerance. In conclusion, silver offers investors exposure to both a precious metal and an important industrial commodity. It can provide diversification, potential inflation protection, and exposure to growing industries such as solar energy and electric vehicles. However, different ways of investing in silver carry different risks. Understanding those differences can help you make more informed investment decisions. In the next video, we'll explain futures contracts in simple terms and show how investors use them to gain exposure to silver, oil, agricultural commodities, currencies, and many other markets. This video is for general educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions.